When we approach the markets, we always ask the question, how is the market going to open tomorrow? And the right answer is nobody knows. And that's the right answer because truly no one knows. Yet, traders in their approach the market in a way that they think that trading is some sort of a predictive type activity. So they're trying to predict. Now, I know I've touched on it in past podcasts where I been telling traders that, trading is all about decision making. But today I'm just going to try and put it in some sort of a process. So let's just stay with me on this logic just for a little bit, and then we'll build on it. So if we don't know what's going to happen tomorrow, we confuse with time frames. We think we don't know what's going to happen tomorrow, but when we look at charts, we try and predict what's going to happen in the next 5 minutes, 10 minutes, 15 minutes. And this is why we listen to analysts on TV. They say the market is going to go up in the next quarter or the next day, or they see that this activity will continue for the week or the next day. And, this is why we pay newsletters so much money to get predictions from them, because in our hearts, we still want to believe that somebody else knows the market out there. But the truth is, I don't approach anything as a prediction model. You can't predict anything, and that is the truth. And a lot of people who have been trading for a long time understand that. And the beginners don't understand that, because in the beginner's mind, well, if I can't predict the market, how am I going to make money? I have to predict that the market is going to go up or it's going to go down or anything like that, right? And there is some truth to that, but the fact that you place a trade from that moment on, again, as I mentioned in another podcast, you don't know the future. And there's a lot of uncertainty. So what you have to do is, before you place a trade, whether to go long or to go short, you have to approach it in some sort of a process, right? So let's walk through this process a little bit. The first thing that you have to understand is that what you're really trying to determine in every single possible trade is the risk and the reward. That's really it. It's not about predicting whether the market is going to go up or going to go down. It's about predicting the right risk and reward and acting on it. So this is where it basically starts. Let's look at somebody who's a chart trader, right? I know there are dome traders, but really the same logic would apply. So I would assume that majority of the people are chart traders, and they look at charts and they're fluctuating back and forth. And at some point you say, well, I think the market is going to go up, right? Okay. Now, at that point that you think the market is going to go up, what you're really thinking of is some sort of a probability, right? You don't know if it's going to go up or down, naturally. But what you want to do is build some sort of a risk and reward model at this point. If you think it's going to go up, what is the reward that you expect out of it? And what is the risk that you expect to take on yourself in assuming this trade? This is the first action, right? So let's use, for example, the E-mini contract, the E-mini S&P. You are going into the market and now you're saying, okay, I'm going to go long. I have the setup. Probability is that it could potentially go up, and I use the word potentially here. My reward that I expect out of this move is 5 points, and I'm going to risk 3 points. Now you have a reward that's higher than your risk. This is really the most important first part in your trade, determining the risk and reward. So charts do not predict the future. Any patterns you find or anything of that sort, whatever happened in the past happens in the past. Hence the disclaimer, past performance is not indicative of future results. It's a smart disclaimer. It's an intelligent disclaimer that our regulators have said, because the reality is whatever happened in the past does not mean anything about the future. Anything. So again, you're going to your risk and reward. Once you determine your risk and reward, the second thing that you have to determine is the timing of your trade, right? So you determine the timing, and when the timing is right for you, when the setup occurs, that's when you enter the market. So now you have the risk and reward behind you, and now you have the timing. If you combine risk and reward and timing, what it does, it gives you a possibility to win. Not a probability, it gives you a possibility, right? Now, because the probability is really in the combination of all those things, whether it's going to be a positive or a negative trade. It's your risk and reward after 100 trades, not just one. So here you have risk and reward, the first thing, then timing, then it gives you a possibility, and basically you enter the market, right? That's what happens. So your decisions should be oriented around this type of idea. And whether you're a trader, short-term trader, whether you are long-term investor or anything like that, those are the three things that are extremely important, right? So essentially, you're trying to build odds that are in your favor. This is what you're all trying to do. The combination of risk, reward, and timing can give you potentially better odds than other traders that just enter the market, on a gut feel, on a limb, or they think, or, whatever the case is. So those odds are basically what will determine your success in the future. Remember, short-term success is meaningless. It's absolutely meaningless, especially in a bull market like we have right now, that you can potentially, on every, so far at least I should say, that every time it went down, it went up, it went down, it went up. But even in that market, even though it's trading up, if you're a day trader, you know that it's very hard to trade it, right? It's because again, everything that I'm telling you that it went back up, it's on hindsight, right? You don't know if tomorrow is going to be a huge correction. Some sort of a tweet could be from our president, could be a tweet from the Fed, could be, or it could be from the World Health Organization. Anything could just sabotage it. So essentially, what you're building here is probability. And if you think about it for a minute, building this kind of model does not really only relate to trading, right? I mean, there's a lot of people who look at risk and reward of things and timing, risk and reward and timing. And those are the things that you keep on looking at. And this is how you get to the decision-making part. When I spoke today to one of our potential customers, we were discussing the fact that it's decision-making. But he asked me a very intelligent question. Well, how do I make those decisions? Right? Like what does entail? It's a decision making, which is true. I don't think I've ever explained it. So the decision making is really not thinking of the market as a mechanism that you can predict, but rather thinking of it as a mechanism that you work with probabilities. And this is what you orient yourself around. Now, if you think along those lines, that I can't predict the future, but I can build models that are built on risk and reward and timing, and that's what gives me really the possibility to have a positive expectancy, or as we say, a profitable trade. That's what's going to give you the confidence, I believe, to develop, or I should say, further your method when times will be volatile or less volatile. I'll give you an example. So let's say you think about risk, reward, and timing, right? It gives you the possibility. So let's say the market right now, it's kind of has, again, for to each his own. I mean, for everybody, this market could be highly volatile. To us, To me, I mean, the last few weeks it wasn't. So, it just fluctuates in a normal manner as markets fluctuate, as opposed to abnormal fluctuations that we had during COVID, in February, March, April, and so forth. So, now we have some sort of a, I would say, for lack of a better word, a normal pace of the market. Now, if you think about in terms of risk reward timing possibility, imagine that one day the market is extremely volatile and we're going to go back to that volatility, right? So now you're going to think about, okay, how do I define my risk and reward now? Is the risk worth my reward? Maybe it is, maybe it isn't. I'm not here to determine, but no question that at this point, now you're not trying to determine in this volatility, this insane volatility, whether the market is going to go up or down, or if we were to have an insane market like we had in COVID. What you will determine is basically risk and reward ratios. And then you will have to determine the obstacle of timing. Where do I enter this trade when to get this risk and reward? So you may determine that you can't get the timing right. The market is just all over the place. I mean, during COVID, it went up 100 points, down 100 points. I mean, it could happen again. It will happen again. There's no question. This type of behavior, there's always a different catalyst for it. And again, risk is after you thought of everything, right? It's after you thought of everything, and then something happens that nobody anticipated, and that takes the market by surprise, and it's shocking the market, and you have that. That's why really market react. Markets are very smart mechanisms. Markets actually integrate the collective thought of all of us as people. However, they didn't think about COVID, right? I mean, because nobody even, not that people didn't talk about it, about, pandemics, but the market didn't factor it as much. So think about the next time, right? Of maybe if the timing is not right, then you can trade, which is okay, not taking a position, because you might have the right risk and reward for your setups, but you can't get the timing right. Or you might get the timing, but you can't figure out because of the fluctuations, the risk and reward. You just don't have those two elements, which doesn't give you the possibility to enter the market. Right? Okay. Those three concepts are very, very important to comprehend, because if you want to stay in the markets long term, I think you have to really drill those ideas of risk reward timing that leads to a possibility right into your DNA. And the reason that I'm saying it is because there are many times in the marketplace that are so devastating. And again, by the way, I don't think that the COVID thing was as bad despite all the volatility. And again, this is my personal opinion. And I don't want to state anything as a fact because, and you can disagree with me. But I think despite the COVID-19 issue we had, the market still went back up because of technology companies. But I've actually been through 2008. And that was devastating. That was just devastating. Markets that went down and down and down and down. I think at some point the index were down like 50%. Now what happens at the time, during the time, which you might, I don't know how old you are now, whether you believe me or not, but there was an entire generation that was so devastated from what happened in 2008 that they really did not enjoy the ride of a bull market right after. They just didn't, because they were just shocked from what happened. And I don't blame them. I understand. But what I really realized along the way, that since the Great Depression, there were so many bad markets, and those bad markets sometimes devastate certain people to such an extent they don't even want to touch trading, let alone, in this modern day and age, day trading. So you had, for example, I don't want to go back very far in history, but we can definitely go back to the NASDAQ days in the 90s. The market just went through the roof, right? People were buying, selling. Again, there was no thinking of risk, reward, or timing, or anything. They were just buying and selling as the market went up. And then the market collapsed. Think about it. Just the market collapsed wiped out all those day traders. I remember entire brokerages were wiped out, divisions. Not going to mention the name of the bank, but I was very young at the time, and I was on the trading floor of one of the banks, in New York, and they had a whole section in the back of traders. I think they were the Nasdaq traders. At least they were very happy at the time, so they looked like Nasdaq traders. But I remember the pictures after of empty desks, right? So there's always a generation out there that goes through some sort of a devastation and will not trade again. And if you don't want to be, one of those people who trades and then goes through this devastation, I really believe that what I told you today can really help you in trading. And again, I'm going to repeat it. Don't think of the market or, your dome reading, your chart reading, your whatever analysis you use out there as a predictive model. Think of it as in terms of risk, reward, trying to get the right timing, which will gives you a possibility to gain. And essentially, if you treat it like that model, I believe that you will be able to weather, potentially weather, very bad times if the markets were to correct in such a way. One way you'll be able to do it, it's either adjusting your risk and reward, or just coming to the conclusion that, rather than trying to gain, you can't get the timing or risk and reward, so you just avoid it altogether, and then you continue when there is a better period out there. So whatever decision you take as a result, I hope that it helps you. That's it for now. I hope this helps you. If you want to ask me trading questions that would give me also ideas to post, or I should say record on this podcast, you can go to community.optimusfutures.com and you can ask me any trading question. I'm always talking to traders, and I always try to understand their obstacles. Here at Optimus Futures, we run a discount firm. We run a self-directed discount firm, but nevertheless, we talk to people, and as a result of that, what I do is basically, some of the people tell me the process that they go through. And then I have those aha moments, and which leads me, well, this is what I'm going to explain to you guys, right? So everything that I talk about every day is really a result of talking to people who are coming to our brokerage at Optimus Futures, and they basically, just kind of ask us questions. Sometimes they don't ask questions. Sometimes they just look for a broker. But somehow along the way, they tell me what they like, what they don't like, previous things that they did, just tell me a little bit about their history. So I find it kind of interesting. Some of the histories, I would say that, many of them are the same. And once in a while, there is, someone who comes through a different background. Today, I spoke to a really nice gentleman, super nice guy, really good guy. He's actually a veteran, of the American Army. And I'm really grateful to him for all the things that he's done for us in this country. And I mean it sincerely. And we really had a heart-to-heart kind of a conversation about, about the process of trading, right? We discussed about the idea of how to approach, situations. And he said something very, very smart, right? He said when somebody approached him with a problem, let's say, somebody of lower rank, I would assume, he didn't just want to hear the problem. He wanted to hear a potential solution. And it's a very intelligent approach also to trading. Being part of the process, a lot of people are looking for mentors, right? And part of the process, once you recognize the issue, then you have to start thinking, well, how do I fix it? So you come to somebody with experience, and do I fix it that way? Clearly, a commander is not always looking for, a lower ranking soldier to give him a solution, but he wants to evolve him in a way to be also a decision maker and one that will solve its own issues. Part of this podcast is really to challenge you as well. You say, well, if you have problems in trading, then I go out there and I say, okay, well, what's the solution? And sometimes you don't have the solution, so at least I want to give you some tools to think about, what I said before: risk, reward, timing that leads to a possibility. That's basically it. I've actually been recording at 20 minutes and I didn't even notice. So it's a little bit longer than usual, but I hope it helps you. In any case, I wish you a great week. We would love to earn your business here at Optimus Futures. If you come to www.optimusfutures.com, call us. We'd like to accommodate you. If you need to call us in North America, it's 1-800-771-6748. And locally, it's 561-367-8686. And again, I just want to remind everyone that there's a substantial risk of loss in futures trading. Past performance is not indicative of future results. Please trade only with your risk capital. Don't do things that will put your livelihood at jeopardy. That's it for now, and until the next podcast, this is Matt Z. See you later.